What we've seen year to date is cyclical or economically sensitive sectors handily beat the market and really trounce defensive sectors. And that's important as a factor to watch because the more economically sensitive sectors beat the market, the more likely it is that the market is higher in the future, usually led by cyclicals. So the question becomes, are there any other indicators that I'm looking at that corroborate that story? And I'll give you three. One is about the season we're about to get into, which is earnings season. Earnings has already contracted, and from a revision perspective, second derivative looks to be improving. When earnings is at a contractionary level and starts to get less bad, that is usually, over the course of the next year, higher odds of outperformance for those economically or cyclical sectors. The second thing is, there is that quote of so goes housing, so goes the economy. Now, what we've seen in residential investment or kind of housing, the housing component of GDP, over the course of the last year has contracted by about 20%. And if housing starts are an indicator, that looks to be turning as well. That has usually been a very strong statistical tailwind for GDP growth, which is also very positive for cyclical outperformance. And the third one is closely related. Leading economic indicators, or LEIs, regardless of how you contract it, are also at bottom quartile levels and turning in terms of the second derivative. That is also a pro-cyclical push. So when you think about cyclicals versus defensives in your portfolio, you not only have momentum behind you that we've seen year to date, but you also have the second derivative impact of earnings growth, housing potentially, and leading indicators as well. The top three sectors that I'm watching: technology, consumer discretionary, and industrials, and all three look more interesting to me as you go down the cap spectrum into mid or small caps.